Let me start with something that genuinely kept me up at night after I learned about it. California, January. Same street, same week. Two houses completely burned to the ground. By Tuesday morning, both families are standing in front of nothing but ash and a concrete slab. First family makes around $85,000 a year. They call their insurance company. An adjuster shows up 2 weeks later. A partial check arrives 3 months after that. Then comes a dispute about their 14-year-old roof. And at the end of all that, a letter saying, "We won't be insuring you next year." A state regulator later dug into similar cases and found 398 alleged violations. The California Insurance Commissioner's actual words were that these companies delayed, underpaid, and buried policyholders in red tape at the worst moment of their lives. Second family has a net worth of around $6 million. They also call their insurer. An adjuster is at their door the very next morning. Within weeks, they're offered a full cash settlement, no obligation to rebuild, no roof argument, no non-renewal letter. Same fire, same state, same week. And at that exact same time, somewhere else in this country, a major health insurer was reportedly running an algorithm that rejected medical claims at a rate of roughly 1 denial every 1.2 seconds. No human reading the file, just a machine saying no. I'm Daniel, and today we're climbing the income ladder, rung by rung, and looking at exactly what kind of insurance you actually get at each level. Because what nobody tells you is this: it isn't one industry treating everyone fairly. It's a sorting machine, and your category gets decided before you ever fill out a single form. The bottom rung. Picture someone who does everything right. She's 34, single mom, 2 kids, renting a 2-bedroom in Phoenix, works as a hospital technician, takes home around $35,000 a year after taxes. Back in 2021, a medical emergency hit. Bills piled up. Credit score dropped to 612. She drives a 2014 Toyota Camry she owns outright, no loans, and her driving record completely clean, not one accident in her entire life. She goes online to get a car insurance quote. Here's what happens. In most American states, insurance companies are completely legal in charging you more based on your credit score. According to the Consumer Federation of America, drivers with poor credit pay an average of 115% more than drivers with excellent credit for the exact same car, the exact same coverage, the exact same driving history. Let that sit. Same car, 0 accidents, twice the price. Just because of a credit score that was originally designed to predict whether you'd pay back a loan and is now somehow being used to predict whether you'll crash a car. The scientific link between those two things? Non-existent. The link to your premium? About $1,200 extra every year. And it doesn't stop there. Your job title affects your rate too. Testing done in New Orleans found GE Co. quoted a factory worker without a college degree 91% more than an attorney with the identical driving record. In Baltimore, Progressive quoted a factory worker $1,818 a year. A plant supervisor, same address, same record, got quoted $1,362. Nothing changed except the job title on the form. Renting instead of owning? Pay more. Living in certain zip codes? Pay more. A 2017 investigation by ProPublica found some major insurers charging up to 30% more in minority neighborhoods than in comparable white neighborhoods with identical claims histories. Same risk on paper, different bill in reality. And here's the one that genuinely makes me angry. If you ever had a gap in coverage because you simply couldn't afford it for a couple months, you now get hit with a surcharge. They literally penalize you for once being too poor to pay them. She ends up insured by a company you've probably seen on a billboard near a payday loan shop.
State minimum liability, the absolute weakest coverage that legally allows you to drive, costs her $280 a month. Her Camry is worth maybe $4,000. She's paying more in annual premiums than the car is actually worth. She's not really insured. She's just legally allowed to be on the road. There's a difference. Health insurance? She's on a bronze ACA plan with a $7,500 deductible, which means insurance doesn't actually activate until she's already spent $7,500 out of her own pocket. She has a card. She does not have coverage in any meaningful sense. Then come the life insurance predators, burial policy ads on daytime TV, dollar-a-month plans targeted directly at people like her elderly mother. One major company currently faces a class action lawsuit alleging they sell these policies, ask deliberately vague health questions up front, and then, after Grandma passes, dig through her entire medical history to find something minor and use it to deny the claim. Grandma paid premiums for years. The family gets a sympathy card and a refund check. I genuinely cannot think of another product that gets advertised during Wheel of Fortune and litigated in federal court simultaneously. The middle class trap. You make around $80,000. Decent car, 401k, health insurance through your employer, a house you bought before prices went completely insane. Every 6 months, your auto renewal comes in slightly higher than before, and you don't really know why, but you also don't have the bandwidth to deal with it. This is actually the most dangerous tier, not because the products are the worst, they're not, but because this is where the system is most efficient at quietly draining money from you while making you feel like everything is fine. Here's the real problem with being middle class and insured. You have just enough assets to be worth suing, but not nearly enough protection to actually defend yourself. If you, your spouse, or your kid rear-ends someone on the highway, and that person suffers a serious injury, modern jury awards regularly exceed $2 million. Your auto liability cap is probably $300,000. Your homeowner's liability may be $500,000. Plaintiff attorneys literally look up your net worth before deciding to pursue you. And at this income level, you are the sweet spot. Enough to take, not enough to fight back. Here's what's almost funny. An umbrella policy that gives you an extra $1 million in liability protection costs somewhere between $200 and $400 a year. That's it. The same company that sends you a holiday card every December has never once proactively called to sell you one, because this is one of the rare insurance products that actually delivers real value, which is exactly why it isn't being pushed on you. What they will push on you is whole life insurance. A healthy 35-year-old can get a 20-year term life policy with a $500,000 death benefit for around $25 to $35 a month. The same death benefit in a whole life policy, $500 to $700 a month, 15 to 20 times more expensive. The reason is straightforward. An agent's first-year commission on whole life can run anywhere from 70 to 110% of your first year's premium. Nobody is lying to your face. They're just being paid an extraordinary amount of money to point you in a specific direction. Then there's prior authorization in health insurance, which sounds administrative and boring until it happens to you. It means the insurance company gets to decide whether you can actually receive the treatment your own doctor ordered. One major insurer reportedly ran an internal review system so fast that denials were being issued at roughly one denial every 1.2 seconds. A former company physician described the job simply as, "We literally click and submit." In late 2024, the CEO of United Healthcare was shot and killed in New York City. Investigators noted that words like deny and defend were found at the scene. When the company posted condolences online, that post received approximately 100,000 laughing emojis.
That's not nothing. That's a real, measurable signal of exactly how Americans feel about what health insurance has become. Upper middle class, where things get polite. Household income between $150,000 and $300,000. Senior engineer, law partner, small business owner, dual income professional couple. Real investments, a real house, a financial advisor you actually remember the name of. This is where insurance companies start treating you like a customer they'd like to keep. Competitive auto quotes, low deductibles, real doctor networks, appointments that don't require a 3-week wait. But this is also the tier where the most sophisticated sales machinery operates. Concierge medicine gets pitched here. $2,000 to $5,000 a year for a primary care doctor whose patient panel is around 600 people instead of the usual 3,000 to 4,000. Same physician, same medical license, but now they actually have time to spend with you. It's a legitimate service. It's also essentially a fee you're paying for the right to be treated like a human being inside a system that already collects your premiums. Indexed universal life policies show up here too, sold as a way to grow money tax-free using the stock market, but with return caps around 8 to 12%, a floor at 0, and fees that take some creative math to fully understand. For certain buyers in certain situations, the numbers work out. For most people, they don't. The commission, however, always works out for someone else. And this is finally the tier where somebody actually says the word umbrella to you out loud. Usually a financial advisor who's mildly irritated nobody brought it up sooner. You get $2 million in liability coverage for around $300 a year, and you immediately wonder why this wasn't mentioned years ago. It wasn't mentioned because you weren't worth the conversation yet. The top, the version nobody advertises. Net worth above $5 million. Income $750,000 and up. The industry calls this high net worth, which is just a polished way of saying this is the customer we actually want. You're not buying homeowners insurance from a company that runs Super Bowl commercials. You're buying from Chubb, AIG Private Client, Pure Insurance, Cincinnati Financial, names that don't need to advertise because their clients don't leave. Your policy doesn't pay actual cash value. It doesn't even pay standard replacement cost. It pays guaranteed replacement cost, meaning if your $3 million home burns down and construction costs have spiked 40% because the entire neighborhood went up, the policy rebuilds it anyway. Full stop. And here's the part that sounds made up. Most of these high-end policies include a cash settlement option. House burns down, you take the check up to policy limits and walk away. No rebuilding required. Buy somewhere else, move to another state, retire early. Completely your decision. That option does not exist on a standard State Farm or Allstate policy. It simply isn't offered. When you file a claim at this level, you don't navigate a phone tree. You call an adjuster's direct cell number. Some carriers proactively send someone to your home before any disaster, just to scan for risks and make sure everything is up to standard. Health insurance at this tier is whatever you want it to be. Concierge doctors who respond to texts at 11 p.m. Some services operate with a doctor-to-patient ratio of around 50 families per physician. Not 5,000, not 500, 50. And if the doctor recommends something, nobody argues with prior authorization. They just pay cash. The insurance policy exists for catastrophic events they hope never happen. It's a backstop, not a healthcare system. Life insurance here is essentially an estate planning tool wearing a death benefit as a disguise. A 2024 Senate investigation found that one specific high-end policy structure was being used to shelter an estimated $40 billion from inheritance taxes. Same two words on the contract, life insurance, completely different product from what gets sold at grandma's kitchen table. Step back and look at the whole picture. In 2024, the property and casualty insurance industry posted roughly $170 billion in net income. The CEO of Allstate took home approximately $26 million in total compensation. The industry spent over $100 million lobbying the federal government. And the people being denied, dropped, surcharged, non-renewed, and buried in red tape? Almost exclusively in the bottom two tiers. So, what can you actually do? Shop your auto insurance every 2 years instead of letting it quietly auto-renew.
Loyalty is not rewarded in this industry. It's monetized against you. Stop buying whole life insurance from anyone whose commission depends on your signature at that specific meeting. Buy the umbrella policy the day your net worth enters territory worth suing over. It's $200 to $400 a year. There is almost no scenario where it isn't worth it. Read your homeowner's policy and find the section about your roof, specifically whether it pays actual cash value or replacement cost. That one sentence is worth more than everything else in the document combined. But the biggest shift, and honestly the one that takes the longest to internalize, insurance is not a relationship, it is a contract. They do not care about you. They never did. The wealthy understood this a long time ago and built their entire approach around that reality. They treat insurance like the cold, transactional, adversarial product it actually is. They layer umbrellas. They pay more upfront for carriers that actually pay claims without a fight. They approach their coverage the way a CFO approaches a vendor contract. The rest of us treat it like a service from a friendly company with a cute mascot, and we get treated accordingly. Go back to those two houses at the start. Same street, same fire, same week. Completely different outcomes. The gap between them wasn't luck. It wasn't even really about money. It was about understanding, early, which version of this industry you were actually buying from. See you in the next one.